Look, today we're going to be focusing predominantly on residential property. I spoke a little bit about commercial, and with the time frame that we've got, we probably don't have enough time to cover both sectors from an investment standpoint. So look, just following on from what Steve mentioned before, and I think it's really, really important that you know what you're getting into when you're speaking with agents. So there are probably four main different types of agents, if you like. Okay, so buyer's agent represents the buyer. He's paid by the buyer to go and source a property. There's the project marketer, which is probably what Steve was alluding to before. They sell off the plan, house and land packages, these sorts of investments. Show of hands of anyone that's been contacted or had any interaction with these sorts of people? I'm very happy then. That's good. The issue that you get with these people is that they take data that looks really, really good and probably applies to houses, and then they apply it to whatever they're selling, right? So in Steve's example, if he had bought 10 years ago a property in Woolloongabba, it'd be worth more than 2 times what he bought it for in terms of a house. Whereas the units are stagnant, there's plenty of supply. And more importantly, there's not enough disparity between apartments and houses in the pricing. And that's what causes the growth in apartments like what we're seeing in Sydney. Sydney's one of the few markets where we see pretty consistent apartment growth. Still nowhere near what you get on a house, but still very healthy growth. In Brisbane, it still can't support apartments from a growth perspective, and it still can't support townhouses from a growth perspective because the disparity is just not there. Melbourne is a little bit patchy. So some of the Art Decos, penthouses, those sorts of things perform well. But again, you're always going to perform much better by going into a land component property or high land component property. The buyer's agent we spoke about briefly, and again, if you're going to get advice, that's probably the path that you want to go down. Where you want to be careful here is a lot of them work on a percentage basis. So ideally you want someone that works on a flat fee, so they're not incentivised to push you to the top of your budget or push you above your budget. And there's someone like me, we're a property advisor, which is probably a combination of a buyer's agent, but also combining research with that as well. Okay. Again, I spoke on Friday about the importance of having a good team around you. We believe about that internally as well, that we should have expertise in-house, whether it's valuation expertise, whether it's research expertise, people that are on the ground know what to look for in inspection, and so on and so forth. Who feels pretty disheartened with what's going on at the moment in the property market in terms of the ability to acquire? It's pretty scary, isn't it? When did it all start? COVID sort of blurred our memories a little bit. It actually started mid-19. So from mid-2019 to when COVID hit, we were on track for the fastest trough to peak recovery ever in the property market. It was accelerating at a rate that we had never seen before. That's the dark blue in there. Okay. COVID came and we sort of went sideways for a little bit, probably slightly up even, particularly towards the end of the year. And now we've just sort of picked up where we left off at the beginning of COVID. So a lot of people, a lot of people associate this boom with this all happened after COVID. Well, it didn't. It actually started probably in about May, June 2019. So we had the drop from about mid-17 till about that time, and then we had this rapid rise after that point in time. So is there a question? No? Okay, cool. So with that in mind, what was driving the market? Come on, I'm picking on you today. I'm going to start pointing people out.
Cost of capital cheap.
Interest rates, yeah, absolutely. Historical low. I think there's consensus amongst all economists that this is going to be the environment probably for the next decade or so. What else? Let's talk post-COVID. Disposable income, cash in bank. We've got now, I think it's up to about $120 billion extra money sitting in bank accounts than otherwise would have been. They couldn't. And they still can't to an extent on international travel and whatever else it may be. Now, most of the hands were owner-occupiers. I'm guessing that COVID made you maybe feel a little bit like this. Right? So most of our residential clients that are coming to us, normally we have about a 50-50 split, give or take. At the moment, it's about 80% owner-occupied, 20% investor. And by far and away, everyone says to me, having had to spend time at home for an extended period last year, we realised that we weren't really happy with the place that we were living in. So the people that are living in small apartments, going to large apartments to townhouses, townhouses to small houses to big houses, and on it goes, right? So that has been a massive driver of the second half of the boom, has been the owner-occupiers. Does anyone relate to that a little bit, or is it only the people that I'm seeing? Yeah. So then the other question that I get asked is that, well, last time we had this sort of a boom, the regulations basically put the brakes on, I guess, the property growth and sent it into a little bit of a spiral because lending and access to capital became harder. So why wouldn't they do that this time? And it's a very, very valid question. There are a few reasons why that macro-prudential regulation probably won't work. One is that, unlike previously, percentage of interest-only loans is at a historical low, or within a historically low period. So again, clamping down on that's not really going to have any impact. The percentage of loans at debt to income ratio is sitting at around 6 times overall nationally. About 8 times in Sydney and about 7.5 in Melbourne. Okay, well within historical averages. So again, that's not a trigger. LVRs are up slightly. But the big one is this market's being driven by owner-occupiers. So putting in regulations that may, I guess, prohibit investors from coming into the market isn't really going to work. So in my opinion, and I think opinion of a lot of others, nothing in the foreseeable future is going to happen in that regard. Probably the other big driver, herd mentality, right? Fear of missing out, surging consumer confidence. They're the things that, I guess, get people to spring into action. For one of the first times ever, again, because it's being driven by owner-occupiers, we see every single capital city increasing in value at the same time. Right? Almost never happened before. Well, not in my years anyway, that I can remember. Every single market you can see is trending upwards. How much is it growing? It's really how long's a piece of string. Every area is different. But probably on average, if we're talking about Sydney and Melbourne and Brisbane, from, let's say, first quarter last year to now, we've seen probably 20 to 30% growth on houses. Now, they're not the figures that you're going to see in the average figures when you look on RP data and what have you, but on the ground, that's what we're seeing. Okay. Houses or apartments? So Steve's given me a very good intro into this segment. So this is what they call a pain and gain report. So when people sell their properties, whether they make a gain or a loss and suffer a bit of pain. And you can see, I don't want to go through all those figures, but what I want you to notice is there's a lot more pain in the units across every sector compared to houses on loss-making resales. Okay, and that's really going to be the theme of a lot of what we speak about today. Okay. Any questions there? No? Surprise anyone? No? Okay. Why property? I think Steve gave you the answers before, so can we rattle off a few? Why do people like property? Why do we want to invest in property? Why don't we just put everything into shares? Tangible. You can touch it, feel it, mow the lawn, as Steve likes to do. Anything else?
It's fairly safe.
It's viewed as secure. Yeah.
No margin calls.
No margin calls. Yeah. So you're able to leverage highly, right, without the fear of having a margin call or the bank knocking on the door and saying the property's worth less than what you've borrowed. As long as you're making your repayments, they'll continue to honour that loan. It's look, a lot of the corrections are obviously fundamentals of interest rates and supply and demand, and the demand is insatiable at the moment because we've got the internal demand, but then we've got the population growth as well, which is only limited by the amount of people that we allow in. And that's going to be even more so once the borders open up. We've probably been, the gold star student, if you like, across the world, and we're on everyone's radar now if we weren't already before. Which probably brings in another issue with affordability, that when the borders do open up, it's probably going to spur another spike in the market. A few myths around property. Buying new for depreciation. Effectively, that means that you buy a property to get a tax deduction, which is a ridiculous concept, right? If you want to give $1 away to get 50 cents back, I'm happy to write you a very big invoice, and you can come to me and I'll give you as much tax deductions as you want. But it makes no sense. Of course, you're going to get some deductions along the way to help with your holding costs and all those sorts of things. But tax should never be a driver for buying any kind of investment. As doctors, you may have heard of colleagues are buying wildflowers and trees and all these sorts of things, not only limited to property, to get these big tax deductions, and the assets were worthless. In property, it's very much the same. You go and you buy these high-rise apartments, and like Steve did, and you get great income, you get great depreciation and tax benefits, but you get no growth. Why do you buy property? For growth. So if you're not going to get what you ultimately want from that asset, you shouldn't buy it in the first place. Okay. Contradicting myself here, apartments do perform, right? But you just got to choose them carefully. You've got to choose the market carefully and the type of apartment carefully. For me, if I was buying an apartment in Sydney, I'd buy an Art Deco apartment in Randwick or Coogee or whatever else it is every day of the week over a new apartment in Mascot. Right. The other thing that I encounter a lot with doctors is a race to see how many properties that you can acquire or how many properties you can have. And it's definitely quality over quantity. I would rather have one quality asset than 3 terrible assets. And I'm going to pick on Steve, but I'd rather have one house anywhere in suburban Sydney over 3 of the Woolloongabba apartments that he's purchased. Okay. Risks, covered off the chasing, the tax deductions. Buy because it's right for you, not because everyone else is buying. I think that's a key thing as well. And it's got to be the right timing for you, regardless of whether property gets more expensive or not. Okay. Don't be speculative with your investments. People try to get clever in markets like this and start looking up the cheapest property they can find in Sydney and then go and buy that, or start looking regionally or whatever else it may be. Make sure you stick to the fundamentals. And probably, again, tying into all of that, property is not regulated, so be careful who you're getting your advice from. There's no implication on me if I was to give you absolutely terrible advice on, again, I'll pick on Steve, on an apartment in Woolloongabba. There's no consequences at all. Okay. So for me, one of my favourite things to do with clients are active strategies. When I talk about active strategies, I talk about strategies where I can manufacture gains, where I'm not reliant on the market movement. Right? I can do something to that property or that piece of land to create equity. With that in mind, anyone want to have another guess? What's something that I can do to a property to increase its value?
Renovate it.
Renovate it. Simplest form.
Divide it into 2
Divide it into two duplexes. Subdivide it. Yeah, absolutely. Good.
Give it something, you know, I don't know.
What's my trade-off when I buy a property like that?
The work, time.
The work, time, cost, holding costs, right? So let's compare the pair. Same property, I hope. A little bit of a different paint job and landscaping, but for all intensive purposes, the same property. I'm going to ask you to assume that these properties are right next door to one another, right? But the one on the right has a zoning that allows it to be split into 2 blocks, let's use that, into a duplex, whereas the one on the left does not. They're exactly the same house on exactly the same amount of land. Which one's worth more?
The one that you can split.
Everyone agree with that? Yeah? Why?
It's just because of the potential for growth.
Because of the potential, the intrinsic value in the land. Which one rents for more? Rents the same. Why?
Same house.
Your tenant doesn't care about what you can do with the block or whatever. He's not going to pay you extra for the privilege of living on a duplex site, right?
Which is not one at the moment.
Yeah, that's right. So let's assume, again, I've just picked out some random numbers. So let's assume a 20% premium, it may be more. For the privilege of having the property on the right, you're not getting less dollars in rent, you're getting a lower yield. And the point that I want to illustrate here is that anyone that tells you you can go and buy a property off the shelf that is high income, high growth, high tax deductions, high everything, is lying to you. You've got to choose. You want high growth, you're going to sacrifice income. You want high income, Steve, Will and Gabba, I've picked on you a lot, right? You're going to have very low growth or no growth or negative growth. Why do we buy property? Growth.
Can
Right.
I just say,
100% correct, of course. My property was positively geared from day one at 110% borrowing.
Yeah,
That should have been a sign.
yeah, yeah. Look, it's a point. It's a trade-off, right?
Yes,
it's a trade-off.
But I didn't buy it for
Yeah.
the income.
And for someone that's maybe retiring and all they care about is an income stream, it could be a decent asset, right? Depending on the expenses and all those sorts of things. So, and again, I could go into bigger block of land, smaller block of land, same houses on there. Again, you're probably not going to get a premium for having an extra 200 square metres the back. You might get less rent because people don't want to mow the lawn, right? Again, when you go for opportunity, you're going to pay for it in a lower yield. The good news is that when you have an active strategy and you do the work that you want to do to it at some point in the future, you can create high growth, high income, right? The reason for that is that when you buy a property, what's the most expensive component of the property? The land. And that's another lesson. If it's not, do not buy the property, right? And that's why these house and land packages out, you know, between Brisbane and the Gold Coast or wherever you want to, out in the lower Hunter and these sorts of things, the land's probably worth 100 and they're putting a 300 build on it. The build depreciates, the land depreciates, right? So you always want that mix to be a little bit higher. I'll just give you, again, I just want to show you some examples of some things that can be done. And look, there's different levels on the spectrum of the type of active strategy that you take. The simplest being the renovation, and probably, you know, on the other end of the spectrum is a knockdown rebuild, right, for maybe a townhouse site or something like that. The ugly duckling, I was more referring to suburbs than the properties. You know, so in Sydney, probably like in areas like Redfern 10, 15 years ago, Waterloo, these sorts of areas. I've picked this one out, which is in Footscray in Melbourne, which I very much liken to what Redfern was here 15 odd years ago. It is the most affordable suburb within a certain radius of Melbourne CBD. And it does still have some elements in there. But what will trump everything, and you hear location, 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 absolutely. But also the infrastructure and the plans around those particular precincts. Now, I'm not telling everyone to go out and buy in Footscray, but this is just an example. And this was a relatively small site. It was only 374 square metres. It was in one of the lowest zones that you can have in Melbourne. So theoretically, you look at this and you think you probably can't do anything with it, other than maybe a knockdown, rebuild, or something along those lines. But if we look carefully next to that red outline border, what do we see next door to the right? See two tiny blocks. Can you see that? Yeah. So that automatically tells me, you know what, there's a chance of something here. Right? We could potentially put exactly what the lady at the top said. You split the block, knock down and split the block. So that was definitely what came out in the town planning research when we did it on this particular block as well. We ended up acquiring it for that. You probably can't get that for that much now. And it was, at the time, it was about $120,000 under market, and we were in a peak market then as well. And just to tell you the little story behind that, given the agent a call, and and said to her, "What's the story with this property?" And she said, "Oh, I've got these annoying owners, and they're overseas, and I can never get hold of them, and I'm sick of doing opens, and I just want to get rid of the thing." Right? And at that point in time, we probably would have been happy to pay 1.2 to 1.3 million for this site. Right? That's where our assessment sort of came out at, roughly in and around there. And I said, "Okay, well, let's," and it was listed for auction, mind you. "Let's do a deal. What do you think will buy it?" And she said, "They won't take less than 1.1. Right? Going back to what I was saying the other day in terms of ask questions. Ask questions. Right? Don't go in and ask what's the price. Right? Like, just keep it open, keep it discussional. And we said, 1.1, it's a bit heavy. Right? Don't know if we can do 1.1, it's run down, and so on and so forth. We ended up acquiring it, we tidied it up. I'm not a big believer in flipping property. Buy it, subdivide it, build it, flip it. You're probably better off buying another property and holding those both, and you probably get the same, or half the amount of growth with doing nothing. You can always develop down the track. Right? So as long as your cash flow can support it, hold it. Because it may be that you never need to develop the site. Right? Brisbane. Who's heard bad things about Brisbane? Yeah? Most people. Look, and there's a very good reason for that, and it's because a lot of the project marketers sell property in Brisbane. Why do they sell property in Brisbane? Anyone want to have a guess of the commissions that are being paid out by Brisbane developers for house and land packages or off-the-plan apartments? Just throw a number, percentage. If I went tomorrow to a developer in Brisbane and said, "I want to sell your stuff," how much is he going to pay me?
5%.
Minimum 7, up to 9. House and land packages 10 to 12. Right? And these guys say to you, "We don't charge you a cent." Well, you may not pay it physically to them, but you're paying for it, right? It's factored into the cost, which is why when you revalue these things in 6 months' time or 12 months' time or whatever, they're always worth less than what you acquired them at initially. And it's a whole racket. You've got these developers that pre-launch have this little launch dinner where they invite all the valuers, right? With the view of schmoozing them to get the best possible result on the settlement, which they do, but always on revaluation. Almost always, they come out a little bit lower or a lot lower. When I talk about Brisbane, or if you're looking at investing in Brisbane, do not invest outside of Brisbane City Council. Right? Brisbane, or Greater Brisbane, incorporates Ipswich, Caboolture, Logan, all these horrible areas that you do not want to, not bad to live in, but from an investment perspective, you do not want to touch. You need to stay in Brisbane City Council, and even then you need to be careful about where you invest. Okay? Example, Splitter block. So splitter blocks in Brisbane is the traditional block size in Brisbane is 405 square metres. You've got these blocks where, maybe back in the day someone thought, oh, well, I want 800 square metres, and so they buy 2 blocks and they throw a house in the middle of it, right? But they're already separately titled. You knock that house down and you've got 2 titles ready to go, right? There are some complexities with that because in Brisbane they love their Queenslanders and they're protected. So anything built pre-war, pre-1946 cannot be knocked down. Cannot be knocked down. Unless you're in a certain zone, but we won't go into it. So with blocks like this, again, depending on what the width is here, you can apply to have this redone so it's that way. That's one thing that you can do. Fortunately with this block, it was post-46, post-war. So we could knock it down. We renovated it and it was the cheapest and nastiest renovation that you've ever seen. But we did that because we just wanted to get it into a rentable state because the plan was to knock it down. So we gutted the whole thing, painted new bathroom, external paint and everything else for about 60K. And it looked okay actually at the end. Yeah. Sorry mate, I said I wouldn't show one of your properties, but that's okay. Look, it was a great property. It was in a 100 out of 100 ranked school zone. It was a post-war build, which was a positive. We picked it up for 1.23 pre-market. The end value of high-end homes on a block like this would nudge 2 million on each side. Right? The feasibilities for active players in Brisbane are higher than anywhere else in the country. But there are so many complexities to the town planning, you've got to be careful. Okay. So to see, the cash cow. We look at these sorts of things for our clients that may be heading into retirement 5 or 10 years out, and they want an asset that effectively can replace some income as they cut back from work or whatever else it may be. This particular example was in Melbourne, in St Kilda, along one of the main stretches there on Carlisle Street. It was a really difficult acquisition. It was an off-market acquisition, but the difficulty in this was that the current owner didn't want to spook the tenants that were in there, so it was divided up into 11 rooms, right? And most of, absolutely legal. It was a registered boarding house. Yeah, absolutely. And a lot of them had been in there. I think the average tenancy was about 6 years, which is unheard of for boarding houses, right? So every time I went in there, I had to send someone different from the office. So 1 minute, one would go in there, fire inspector, and then the next minute we're a pest and building inspector just to get. So the due diligence on this site took us about 3 months, right? It was about a 5% gross yield, which for Melbourne is outstanding. It's got one of the lowest yield rates in the country of any capital city. More importantly, what interested us wasn't necessarily what it was renting out for now, but what could be done on it. And the town planning advice showed, St Kilda's a little bit like Bondi, so backpackers and high density accommodation and those sorts of things. Showed that the council was highly encouraging of high density boarding houses or student style accommodation. Feasibility showed that we could get 25 to 30 of these studios on this site with no parking required. It depends where you are. So every state's got their own. Every state's got their own thing. But if you look at, in Sydney, for example, in Westmead, they're crying out for them, right? But getting the right side and making it feasible is another matter. In Melbourne, again, it goes by council to council, but you've got uniform zoning across the state. With this particular zoning, which is sort of these zones were brought in about 3 years ago, so they're very fresh. You had to leave, you could basically allow for 75% coverage of the site, which gives you your net lettable area. So internal area, excluding balconies or any sort of external spaces, up to 670 square metres on site. And when you consider that, you know, your studios are sort of 25 odd square metres plus common spaces and things. But there were fallbacks on this site. We could put luxury townhomes on there, and we could also put traditional units with a basement in there as well. So there were different avenues that we could go down should they change their mind about that, or should there be any changes in legislation or anything else that they had some issues. Again, in this area, highly unlikely, main road, St Kilda, this is the sort of stuff they want over there. But again, the idea of this was that we buy an asset that we can hold because of the income. For a while, we've got a corporate in there at the moment that's just running the boarding house themselves, so we just charge them a corporate rental and they don't have to deal with the individual tenancies and the issues that come with that as well. Okay. Secured for $2,060,000. That tells you about $120,000 income a year on that property. Yeah. Duplex. So we spoke about splitting the block. This is one that was fairly recent. It was really in the height of COVID, and the client said to me when it came time, he said, "I'm worried. Should I walk away from my 10% deposit?" Right, and that's the real fear that was out there in those initial months of COVID, of what's going to happen with the property market. There were all these reports of a 30% crash and all these sorts of things. I said to the client, I said, don't give up your 10%, I'll take it, and you can give the 10% to me. Needless to say, he ended up staying with this block. But the reason I bring this up is that duplex sites aren't as easy as they seem. They're not as straightforward as they seem. Just because you have the frontage and the block size does not mean that you can build a duplex. There are a lot of other factors that go into it. Probably one of the most important is stormwater engineering. Which way does the block slope? How are you going to have your stormwater runoff, right? This block sloped backwards. Bad, right? Really bad. What does it mean in this instance? So I brought this up. This is us. What does it mean for that block to become a development site? Where does the stormwater have to go? They want it to follow gravity. It's got to go back. The street, I've just left a little bit there for you. It needs to come out here. And to come out there, I've got to dig up the neighbour's yard, or the guy behind me, their yard. I've got to pay for that as well, on a square meterage rate of what the property's worth for every square metre I dig up. And that's only if they allow me to do it. So if they know I'm going for a development site and I come and knock on the door and say, pretty please, can I dig up your block? If it were me and lived in those blocks that were older homes, I'd say, yeah, sure, $100,000. Right? The advantage that we had with this site, which we really liked, is we backed onto two. So we played them off against each other. Right? We went in there and said, look, we don't really need you, which we did. We'll put a charge line back into the street, which we can't. Right? But which of you wants 30 grand? Right? They both wanted it. Ended up being 20 grand. They negotiated themselves down. Right? So we secured that before securing the property, and then we went in on the property. Right? The example that I guess the learning that I want you to get out of there is, as I said, just because it meets the frontage requirements and the size requirements does not make it a development site. It needs to be feasible, and it needs to be achievable. Right, there's another one that we did very recently actually. It's under contract at the moment, where again, same thing, it was sloping backwards, but by getting the stormwater engineering plan, we could see that there was a pit down the road. We had to dredge 60 metres to get there, and it would cost us $60,000. So we factored that into our feasibility before buying, but we bought the site because we saw something that others wouldn't see. So in that could lie risk, but in it can also lie opportunity. Okay. Top 5 property tips just to finish off. I said this the other day. The agent is not your friend. Do not tell them your life story. Do not tell them your budget. Do not tell them how many properties you've looked at. Just go in there, look at the property. As I said, act like there's blue cheese below your nose and walk out again. They will use the information that you give them against you. Who's been to an auction? Who's participated in an auction? Who's had the agent chapping in their ear the whole time trying to get them to move up because they know exactly where their budget is? Right. Do not give that information away. An agent comes to you at auction, tell them to go away and leave you alone. Right. The biggest one in this market is be realistic with your budget. You know, a lot of the clients that are coming to us saying we're getting blown out of the market, and they are, but they're looking at the wrong property to start with. Do not follow agent guides. If you're going to do it yourself, do a little bit of homework, and that'll get you closer to where you need to be. Because there's opportunity cost in spending too much time on the wrong properties. The ones that were affordable all of a sudden become unaffordable. So make sure that you're spending time on the right properties. Auctions are nerve-wracking things, right? If I'm bidding for myself, which I don't do after one of my last ones, but I get nervous if it's for me. If it's for a client, I'm like, this is fun, right? This is great. I've got no emotional attachment. When you have an emotional attachment, it can get the better of you in an auction scenario. Okay. And look, going back to feasibility and all those sorts of things, put some parameters around what you're going to pay for the property and try to stick to it at an auction. Don't be drawn into making pre-auction offers without having some parameters around the offer process. Do not kickstart an auction that you cannot see. Right? So I'll say, yeah, look, maybe they'll take an offer. Why don't you put one in? What have they got at that point? At that point, they've got your budget, what you're willing to pay, and then they're going to shop it around. Then they're going to come back to you, and there's no transparency. At least in an auction, you can see who's bidding, and you can see whether it's for real. Also, make sure there's a deadline around the offer process as well. So what's the process? I put an offer in, you shop it around, and it goes around and round in circles. Where does it end? When's the decision going to be made? Because theoretically, they could just go round and round, which they're doing a lot now, and then say, look, you know what? Can't decide, we're going to go to auction. And now they know everyone's limit. Right. We did one recently in Mossman, which we jagged, in my opinion, an absolute bargain. We had an agent that kept saying to us, put an offer in, put an offer in. I said, I'm not going to put an offer in so that you can, where are the parameters, where does it end? And wouldn't commit. He kept telling me I can get a deal done. I said, okay, well, get your client to put that number on a contract and sign it, and then bring it to me, and we'll consider it. To my shock, he did. And we went straight to the client, sign this. Right? And I think we got it, in this market, about 10% under what it was worth. Put parameters around any offers that you're going to make. Make sure you know what the process is going to be. And where possible, particularly from an investment standpoint, hold the ability to manufacture growth within the asset. Because that acts not only as, increasing your growth potential within the property, but it also mitigates your risk. You can dig your way out if you like. If the market goes backwards, there's something that you can do to the property to break even or minimise your losses, should you be able to reinvest back in there as well.